Blockchain.com filed to go public this week, confidentially, then issued a press release about the confidential filing the same day. The first crypto IPO of 2026 is down 57% from its listing price. Kraken just laid off 150 people. Ledger paused, Consensys paused, and Blockchain.com just stepped into the queue. The confidential filing process gives insiders months to see the financials before you do. The press release gives them something else entirely, a market test without a retreat clause. Blockchain.com gets to say, we're going public, while you have zero audited numbers to evaluate. 4 things today. The 15-year history that explains why they're rushing now. The scorecard that shows what happens to retail after these IPOs. The mechanism that makes the ICO in a suit. And the one question you should be asking before you buy a single share. Subscribe now. If you have ever wondered why all these crypto companies are going public, this channel is where you get the forensic answer. Let's get into it. Blockchain.com was founded in 2011. Not 2017, when the ICO boom made every 22-year-old with a white paper a millionaire on paper. Not 2020, when DeFi turned yield farming into a spectator sport. 2011, when Bitcoin was a curiosity, a forum experiment, a thing that technically worked but that almost nobody believed would matter. 3 people from the original Bitcoin Talk forum built a wallet. That's it. That was the product. A place to store a thing that most of the world hadn't heard of yet. 15 years later, they have 95 million wallets, 43 million verified users, and $1.1 trillion in transactions processed. By raw numbers, one of the biggest crypto infrastructure companies on the planet. And until this week, most retail investors had never heard of them. That's the first thing worth understanding. This isn't a startup. This is a company that has survived every cycle. The 2013 crash, the 2017 ICO boom and bust, the 2020 DeFi explosion, the 2022 collapse, and they came out the other side still operating. That's legitimacy. That's real. So why are they rushing now? To answer that, you need to follow the valuation. March 2021. Bitcoin is running. Institutions are piling in. Blockchain.com raises $300 million. Post-money valuation, $5.2 billion. That's a real number, built on real infrastructure in a real bull market. 1 year later, March 2022, Series D closes. Valuation, $14 billion. Led by Lightspeed Venture Partners and Bailey Gifford, names that belong on Wall Street letterhead, not a crypto press release. The round prices Blockchain.com at nearly 3 times what it was worth 12 months before. 2 months after that round closes, Terra Luna collapses. Three Arrows Capital, one of the biggest crypto hedge funds in the world at that time, goes under. Blockchain.com had lent money to Three Arrows. That decision left a $270 million hole in their balance sheet. They laid off 25% of staff, closed their Argentinian office. The CEO took a pay cut. November 2023. They raised $110 million, a Series E led by UK-based Kingsway Capital with Bailey Gifford back in the room. The valuation? Approximately $7 billion, less than half the 2022 peak. So, here's the position the company is in right now. The investors who came in at the $14 billion valuation are underwater. The company has been grinding for 3 years, and the private market is not going to reprice them upward. The public market is the exit. That's the mechanism. Yes, Blockchain.com has been putting in the work. The company has been grinding for 3 years, cutting costs, staying profitable on an adjusted basis, expanding into Africa, launching perpetual futures. But the exit looms large. The investors need liquidity, and the mechanism overrules everything. That's why they're filing now. Not because conditions are perfect, not because the crypto market is healthy, because the clock on those 2022 investors is running and the public market is the only exit left. Now, about that press release. Filing a confidential S-1 is not unusual. Since 2017, when the SEC extended the right to all companies, not just emerging growth companies, virtually every company that is considered an IPO has filed confidentially. It is the default. It is so standard that it would be notable if a company didn't do it. What it means in practice, the company works through the SEC review process in private. They get regulatory feedback, they refine their prospectus, they decide whether to proceed. The S-1 only becomes public 15 days before the roadshow. By then, institutional book building is already underway. The people who get early access to the numbers, they're not you. What blockchain.com did differently is they issued a press release the same day. Bloomberg picked it up, CoinDesk ran it, Reuters filed a brief, Bitcoin Magazine published the backstory. The legal filing is confidential. The existence of the filing is now global news. That's not an accident. The press release is a market test. It says, we're going public. It watches how institutional investors react. It watches how the press frames it. It gives the company the ability to build narrative and gauge appetite, with full rights to pull back if the response is wrong and before a single audited number is in the public domain. You, on the other hand, will see the financials 15 days before the stock starts trading. Nobody has to coordinate. They just have the same interest. The history explains why they're filing. The scoreboard explains what you're walking into. Because blockchain.com is not the first crypto company to step up to this window in 2026. They're just the latest. And the ones that went before them have left a very clear record of what happens next. In January 2026, BitGo became the first, and so far the only, crypto-native company to go public in the United States this year. The IPO priced at $18 a share, 13 times oversubscribed. Institutional allocation was filled before the stock started trading. On day one, it opened 24.6% above the offering price, briefly touching $24 a share. By the close of the first session, it had given almost all of that back, up 2.7% for the day. Then it kept going down. Let me be precise about what happened. The IPO was structured so that institutional investors received allocation at $18. Retail buyers entered the market on day one at $22, $23, $24, prices the stock would never see again. By the time the first earnings report landed, BitGo was down 57% from its listing price. That is not volatility. That is the mechanism. Now, 5 months into 2026, here is what the rest of the crypto IPO queue looks like. Kraken, one of the largest crypto exchanges in the world, filed confidentially with the SEC in November 2025, paused in March. Market conditions. Then, on May 5th, co-CEO Arjun Sethi said he stood on the stage at Consensys Miami and told the room the company was about 80% ready to go public. 13 days later, Kraken laid off 150 people. The official explanation? AI efficiencies. The IPO is now reportedly pushed to 2027. Ledger. The French wallet manufacturer that make great hardware wallets. In January, they hired Goldman Sachs, Jefferies, and Barclays to lead a listing that would have valued the company at $4 billion. They opened the New York office. They hired a new CFO. On May 13th, just 8 days ago, they announced an indefinite pause. dynamic market conditions. They never filed a confidential S-1. They got close enough to hire the bankers, then they looked at the market and stopped. Consensys, the company behind MetaMask, Joe Lubin's firm, hired JP Morgan and Goldman Sachs, had been planning to confidentially file with the SEC by the end of February 2026. The markets dropped in February. The filing never happened. IPO now pushed to fall 2026 at the earliest, which means they're watching to see if someone else goes first. Grayscale, the largest crypto asset manager in the world, $20 billion in assets under management, filed confidentially in July 2025, 10 months ago. The filing has not moved. No roadshow, no amended S1, no updated timeline, just silence. That silence is its own data point. Grayscale has more institutional relationships than almost any other company in this industry. If anyone can read the room on whether public market appetite for crypto is real, it's them. They filed. They looked at what they saw, and then they went quiet. So, the scoreboard. BitGo, public, down 57%. Kraken, paused, laying off staff, IPO pushed to 2027. Ledger, indefinitely paused, never even filed. Consensys, planned to file, didn't, waiting for fall. Grayscale, filed 10 months ago, radio silence. 5 companies. 1 is public and down more than half, 2 paused before they could file, 1 filed and it went dark, and the only one that made it to market is trading at 43 cents on the dollar. And blockchain.com just stepped into that line. 5 companies looked at this market and either stopped, slowed down, or watched their stock collapse. Blockchain.com looked at the same market and stepped forward. Once you understand why, you cannot unsee it. But first, the AI framing, because it matters to me. Kraken laid off 150 people and called it AI optimization. Coinbase cut 700 employees in May and cited resource alignment. Block cut 4,000 people, half its workforce, in February. Across crypto, companies have eliminated more than 5,000 jobs in 2026. And AI is in almost every press release. Here is the question nobody really wants to ask out loud. If AI is making these companies more efficient, why does the restructuring always accelerate when crypto prices are declining? Why weren't they cutting jobs during the bull market when efficiency would have meant higher margins? Why does the explanation always arrive at the same time as the balance sheet pressure? AI is not the reason. AI is the narrative. It's the excuse. It gives companies a story that isn't, we can't afford to go public right now. It gives them cover. And cover is valuable when your last valuation was $14 billion and your current one might be half that. The scoreboard tells you what happened. The AI narrative tells you what they want you to believe happened. Those are not the same thing. If you're finding this useful, subscribe now. The channel is the one place connecting these dots in real time. And if you want the full history of how this mechanism is repeated across every cycle, from the 1990s dot-com boom through the ICO era, they even go back to Railroad, the Token Trap is available now on Amazon. There's a link in the description. In 1998, I was an investor and a builder. 1998. I watched an entire industry swap one hype vehicle for another and call it maturation. The dot-com boom created a mechanism. Underwriters priced IPOs below market value. Institutions bought at the offering price. Retail bought on the first day of trading, always higher, often much higher. The underwriters' clients sold into that retail demand. By the time the stock found its real price, the people who got in at the IPO, they were out. And the people who got in on day one were underwater. The vocabulary was different but similar then. Democratizing access to the internet, capturing eyeballs, giving Main Street a seat at the table. The same language you hear today about crypto IPOs and you used to hear about crypto ICOs. The ICO boom of 2017 ran the same mechanism in reverse. Projects raised capital from retail first. VCs came in later at higher valuations with token allocations that vested immediately. Retail held the tokens, VC sold the tokens. The price collapsed, the projects evaporated. I lost $15,000 to the Recoin fraud in 2017. I know what it feels like to be on the wrong side of that mechanism. I wrote about it in The Token Trap because I wanted people to see it before it happened again. It is happening again. The ICO market is dead. The token launch platform is under regulatory scrutiny. Maybe it comes back. Retail has been burned too many times to buy just a white paper. So the mechanism needs a new wrapper. The IPO is that wrapper. Same insiders, same early access, same information asymmetry, same lockup expiration that lets VCs sell before retail can react. The only difference is the document. Instead of a white paper, it's an S1. Instead of a token, it's a share. Instead of a Telegram group, it's the New York Stock Exchange. Well, mostly NASDAQ, but same thing. John Blank is the chief equity strategist at Zacks. He was on CNBC last month talking about the SpaceX and OpenAI IPO filings. He said this, unprompted. I see it as a market top. Back in 1999, we saw the same kind of thing where people were just rushing to get these IPOs out. He was talking about tech, but the pattern is the same one blockchain.com just joined. An equity strategist on CNBC, not a crypto critic, not a YouTuber, not somebody with a book to sell, an equity strategist whose job is to call markets correctly, looked at this wave of IPOs and said, this is 1999. That's not my characterization. That's his. Here is what I want you to see. Blockchain.com is a real company. They have real users. They process real transactions. This is not Recoin. This is not a scam. The people who built it have legitimate reasons to want a public listing. But the mechanism doesn't care about legitimacy. The mechanism cares about sequence. Who sees the numbers first? Who gets allocation first? Who can sell first? Who finds out last? You find out last. You will see the S1 15 days before the roadshow. The institutions will have been reading it for months. You will buy on the open market at whatever price the first day trading sets. The VCs who came in at $5.2 billion and the ones who came in at $14 billion have been waiting years for this moment. They are not buying. They are selling. That is the mechanism. And once you see it, you cannot unsee it. You were never the investor. You were their exit liquidity. I'm Dana Love, PhD. I'll see you in the next one. If this gave you something to think about, subscribe. I put out new analysis often. Drop a comment too. I answer as many as I can. And watch this one next. I picked it for you. Wherever you found me, I'm glad you did. See you in the next one.